that's what the accounting equation is in a very simple form. And if you think about it, you think about if you own your own house, you've got a house and say you buy it for $500,000 and you have $100,000 deposit and you have a $400,000 mortgage. If you think about the accounting equation, it relates to that. You've got an asset equals $500,000 and that equals liabilities of $400,000 plus equity of $100,000. And we can, that sounds reasonable. So say then in 12 months' time, it's the Auckland property market, and that house is now worth $800,000. So if we want to understand what's happened to that accounting equation at that point in time, we'd say, well, our house is now worth $800,000, so the asset is $800,000. Our mortgage is still the same, still $400,000. So therefore, our equity will have gone up to $400,000, right? And so in the context of an accounting entity, so separate entity, this accounting equation always needs to hold true in order for us to be able to have that warm, bubbly feeling that accountants have when everything balances. So what we can do, so to expand out that accounting equation is to do this. So assets, so it's just an extension of that. So it's saying assets are equal to the liabilities of the business plus, and saying equity is actually made up of two things. Equity is made up of money that we've put into the business as owners, so contributed equity, plus profits that have been retained. If we go one step further, and don't worry, we'll talk about this again on Thursday. If we extend that out even further, assets equals liabilities plus contributed equity. And then if we say, well, retained earnings are actually profits of the, so retained earnings is made up of revenue less expenses. And so if this first line is the accounting equation, the next one's a slightly more extended or expanded accounting equation, and that third line's the same. And then if we want to restate that, and you just need to think about this in the context of fifth form, or 15, when you're 15 and did maths at high school, you were able to restate equations so that they still held true. So restated, that's exactly the same equation as the one above it. It's just taken, instead of going liabilities plus contributed equity plus revenue less expenses, we've just essentially added expenses to both sides. So assets plus expenses equals liabilities plus contributed equity plus revenue. Believe it or not, this is what virtually every accounting system is predicated on, is keeping this extended equation in balance. And so every single transaction every single financial transaction that goes through a business affects one of these different, what we call accounts. And of course, you can have, under assets, you can have as many if you like. You could have an asset being bank account and assets and lots of different sub accounts. But this is the extended accounting equation. The reason that I've restated it like that is just to really try and explain the concept of debits and credits. So and debits and credits are purely accountant speak, and the reason they don't make any sense to anybody else is that when we say debit, when one accountant says debit something to another accountant, all we're really saying is a debit is something that is a transaction that increases the things on the left-hand side of that equation. So if we want to increase our assets or increase our expenses, we debit them. And if we want to increase something on the right-hand side, we credit it. And the reason, God knows why they call them debits and credits, but what that means is at any one point in time, the sum of our debits should always equal the sum of our credits. And you go, why is that important, Barry? Why do we as MBA students need to understand debits and credits? Well, you don't really, but one of the comments that was made earlier on was trying to understand accountants' jargon and be able to cut to the chase. I think if you're having a business conversation with an accountant and they start talking about debits and credits, you should probably slap them around the head with something, because they really shouldn't. They should be able to explain it in more meaningful ways, but that's the explanation. So if we think about, I said every transaction can fit into that equation. The first one, get a bank loan for $100,000. Tell me how that would hit that accounting equation and keep it in balance.
Assets up by 100 grand and liabilities up by 100 grand.
Yep. So we follow that. So yep, our bank. So we get a bank loan, and that money comes into our bank account. So, and we've got to say, well, we've now got $100,000 sitting in our bank account, but we need to reflect where it's come from. And we record a liability, which would be bank loan of $100,000. What this is called, this is double entry accounting. So double entry accounting says that every transaction, every financial transaction that the business has affects two accounts. Talked about my note. There's three types of financial performance. First one is profit. So profit is revenue less expenses, and we're going to talk about how we might define revenue and expenses. The second type of financial performance is cash flow, and there is a difference between profit and cash flow, and they can be wildly different. So cash flow is the second type of financial performance we can have in the business, and the third one is what we call structure. And so structure is how the assets that we use in the business and how we fund them. So when we think about financial statements of the business, they are actually sort of directly aligned to those three types of performance. So a statement of financial performance basically has our profit and loss. So that talks about profitability, which is our first type of financial performance. Our second type of financial performance is cash flow, and that's what a statement of cash flow does. It sets out where our cash has come from and where it's going to. And we're going to talk about all of these financial statements in more detail next week. And the third type of performance, which is structure, is wrapped up in our balance sheet. So our balance sheet lists our assets and our liabilities and our equity. So basically what's happened is you've bought a car for $30,000 and your bank's gone down by $30,000. So in that situation, your total assets doesn't change at all. It's just that you've swapped one sort of asset for another. You've swapped some money in your bank account of $30,000. You've swapped that for a car. We'll see it better as we begin to expand this out a little bit. But yeah, essentially in that one, all we've done is we've swapped one asset, the bank balance or money in the bank, with a car, which is also an asset. And so we can see that even though it's gone in and out of one type of account, this whole equation still balances. So what happens with this next one? If we mow some lawns and get paid $50 in cash that we put into the bank, Jesse, do you want to have a go at that?
Okay, so we mow some lawns and get paid $50 in cash that we pay.
Yep.
So I'll say that we have 50 plus 50 in our revenue.
So when you think about it, so firstly, we understand the transaction, right? That we've gone and done some work, and we've been, and little old lady out the road's given us $50, and so we've trotted down to the bank and we've put that in the bank. So you are correct in terms of saying, okay, so that's revenue because we've earned it. It's come from our effort, and it's revenue. So yep. But to keep this accounting equation in balance, where do we put the money? We put the money into the bank, right? So
it will be 50 in the asset.
Yep, perfect. Someone else want to have a go at this next one? Just wave if you like, because I can see you. Yep, Matthew. Yeah, Matthew beat you on there.
Okay, so we buy $10 in fuel for the lawnmower. So our expenses go up by $10, and our assets go down by $10 because we spent cash.
Yep, awesome. And so
how is this different to the car?
That's a great question, and keep it in your mind because we're going to answer it. Because when we think about those two transactions, they're actually kind of similar, aren't they? That what's happened is both of those transactions, our bank account's gone down, but we're saying in one situation we're calling it an asset, and in another situation we're calling it an expense, right? So that's really important. That's a really important point. Is that's the tricky thing with this accounting thing, is that you can actually record a transaction quite easily into an account type that it's not. And if you think about it, if we should have put something into expenses and we didn't, and we accidentally put it into an asset, then remember that the way we generate a statement of financial performance, or our profit and loss account, is our revenue, the total of all of our revenues less the total of all of our expenses. So if we make a mistake and instead of putting something in as an expense, we call it an asset, then when we produce some financial statements, what's going to happen to our profit that shows at the bottom of our financial performance? Is it going to be overstated or understated?
I think I just got it, Barry. So because we're using the fuel straight away, it was an expense and we couldn't keep it as an asset. If we had bought the fuel and stored it, it would have been an asset. And if we've crashed the car the day we bought it and it was gone, then it would have been expense and out of the asset as well, right?
Well, you might just have to keep that to yourself, because that might be an important distinction, but I think you're on the right track. So I like your style. So just come back. So what I'm saying is that we've got these 5 types of accounts, right? We've got revenue and expenses and assets and liabilities and equity. And we're remembering that revenue and expenses are actually kind of like a little subset of equity anyway. It's really easy to I think the technical term is cock up how you record the transaction. And if you cock it up, then it has a flow-through effect, so that if it should have been an expense and you've called it an asset, then it's never going to turn up in your profit and loss account. And as a result, your profit's going to be overstated. Who wants to have a go at this one? Oh, Julian, yep.
So invoicing a client 100K, that'll go to revenue. And then your accounts receivable or debtors in assets also increases 100.
So in New Zealand, we have GST, right? So if we're talking about a GST exclusive transaction, it would be as simple as that, right? But let's say that we actually do this. So it becomes that. Say it becomes we invoice a client $100,000 for a software sale plus GST at 15%. What's the transaction now? Jerome? Yep.
Cheers, Barry. So that would be 115,000 in your bank account, and then 15,000 liabilities, because you have to pay that back.
Yep. So that we basically. Yep, like that. Yep. So what that's saying is, in a situation where you have a GST tax that goes on top of it, or even like a sales tax if you're in a different jurisdiction, what that's saying is our GST exclusive revenue is $100,000, but we've actually invoiced the client. So sitting in debtors, they actually have to pay us $115,000, and that's because it's the GST. But yeah, so of the $115,000, 100,000 is revenue, yeah, and 15,000 is GST. So when you think about it, that's a little bit tricky, isn't it? Because what we're actually saying is 100,000 is revenue, which will generate profit. So revenue less whatever all of our revenues less whatever our expenses are will be profit. But this 15,000 is a liability. So on one hand, when we think about, do we understand the transaction? Yep, we invoice the client for some software. We charge them 100,000 plus GST. They're going to pay us 115,000. Of that 115,000, 100 grand goes to our revenue. $15,000 we're going to have to pay to the IRD, the tax department. So we understand the transaction, and it's such a fundamental premise of getting it right, that you have to understand the transaction. But it blows me away how many people, and all like corporates, chief executives, business owners, investors, right down to plumbers and butchers and bakers, they just don't take the time to understand the transaction. And as I say, often the systematic transaction gets accounted for correctly because it's happening all the time. It's the non-systematic transaction. So that's a nice wee extension of that one. So the next one, and remember, of course, with most things, there is, like in New Zealand anyway, there is a GST context. So when we talk about financial statements, we generally express those excluding GST. And so when we're talking about revenues, they're excluding GST. Expenses are excluding GST. If we buy an asset, if we buy a truck, we get to claim the GST, so we only record the GST exclusive amount. But this accounting equation, still balances even when we account for the GST. And what you find with modern day accounting systems, you generally don't even see the GST get split off into the other account. You just put it in going $100,000 plus GST. Computer says yes, and you rock on, and it all deals with the GST. Right, this next one, Simon, do you think you could have a crack at this for us? Buy $50,000 worth of timber stock for your hardware company.
Yep. So your bank account drops by $50,000, but your assets have also gone up by $50,000 because you've got the stock.
Yep. So we're just replacing one asset with another, right? We're taking our money out and putting it back in. So like that. So again, no net effect on anything else. Accounting equation still balances. And we're sweet as. This next one, we invoice a customer for $40,000 for timber that we sold them. That cost us $20,000. Remember we talked about this the other night, and there's actually 2 transactions. Who's going to have a go?
I can try this again, Barry. Okay, so we invoiced a customer $40,000 for timber, so that should be revenue.
Yep. Actually, before I write them, and tell me all the accounts that are affected. So revenue's affected, and what
revenue's
else?
affected.
So we've invoiced them, but we haven't been paid yet.
Then also the expenses is also impacted. Because
So what have we got? So far we've got revenue of $40,000.
And that should be in the assets because it should go into our bank account.
Yep. So that's debt. So debtors. Yep. So debtors and revenues affected. And then remember, there's a second sort of transaction that we've got to do to account for the fact that we no longer have $20,000 worth of stock.
So that is the $20,000 that is in expenses.
Yep.
Plus expensive and minus assets because it cost us.
Yep. So the first transaction is we record the sale, which is $40,000 worth of revenue and $40,000 worth of debtors. And then we also have $20,000 worth of expenses.
And minus
yeah. So of course, just recognizing, of course, that in here I'm going equal $40,000 minus $20,000. They're actually 2 different asset accounts. So under assets, under here we'd actually have, we'd have 2 columns, if you like. We'd have a column for debtors and a column for stock, and we'd be all fine. Cara, would you be comfortable having a crack at this one?
Can give it a shot. So if they're issuing $1 million of shares, then the equity in the company.
Yep. So first question: what are the 2 accounts that you think are affected? One's equity, and what's the other one?
And the other one is the value. So the asset.
Yep. So what's specific? So you're getting $1 million into your bank. So what would be the other account that you think's affected?
Yeah.
Yep. So right. So and that's, and I know it's sort of a tricky discipline to go through, but first thing is you say, okay, what do we understand the transaction? What accounts do we think are affected? Mm-hmm. And then we say, have they gone up or down? So equity's gone up by $1 million.
Yeah.
Yeah. And our bank account's gone up by $1 million. So this one here, the existing shareholder sells 10% of company shares to another party for $200,000. So first question, do we understand the transaction? What's actually happened here?
Okay, so an existing shareholder sells 10% of a company shares to another party. Okay, so
So before you fire into it,
yeah.
remember one of those accounting principles that we talked about being the accounting entity. So just think we've got the company as a separate entity, which separate from its owners.
Mm-hmm.
So the company can have transactions with its owners.
Yeah.
But that might not be the same as owners having transactions with other owners.
I mean,
It is
logically,
a tricky one. So
would there be a change in anything if the shares are still kind of there? Yeah, and like what Amir just said, nothing happens to the company. Like, ownership's just changed hands. So how does this work out here?
You're actually bang on. It doesn't. It's a financial transaction, right? But but the company is not a party, or this business is not a party to that transaction. So that first question: do we understand the transaction? It's that Billy Bob has sold the shares to whoever, Julie. And the company, you're right. The company hasn't received any money, hasn't paid any money. It hasn't incurred an obligation or a liability, those sorts of things. So I'm just going to stop sharing. So basically there's nothing. So 0, 0, 0, 0, 0.